Okay, and in our news story today, Zoom announced amazing earnings, but their stock is down 17%. Let's look at the numbers here. Zoom's Q3 revenue was $1 billion. I kid you not, 35% increase year over year. Net income was $340 million. That's up 71% year over year. 2019 total revenue was $330 million. And when you look at that 2019 total revenue, $330 million, the revenue was $1 billion in a quarter. So this is a high growth company, super high growth, pretty amazing performance. They have over 2,500 customers paying more than $100K a year. Those are the whales in the system. That means if you were to put if they're paying $100, that'd be $250,000. If they're paying $100,000, that's $250 million. In other words, the whales in their system are 25% of their revenue. Their top 2,500 customers are 25% of their revenue. Extraordinary that people are really paying a lot of money inside corporations for Zoom. And you know what? 100,000 or more is actually not that much if you were a giant company. Why wouldn't you pay that? What were you paying Cisco previously? What would you be paying WebEx or GoToMeeting? Seems actually quite affordable. This is Zoom's 14th consecutive quarter with a trailing 12-month net dollar expansion rate in customers with more than 10 employees above 130%. This means they're growing revenue within existing customers at an absurd rate, which makes sense. Net dollar expansion rate basically means how much money is being paid by existing customers. So how much more are your existing customers spending? If you think about Zoom or Slack or a CRM system like Salesforce, the more people get value from it, the more the person sitting in the cubicle next to them or in another department might deploy that software. So Zoom is bottom-up SaaS, just like Slack and Yammer, which David Sachs kind of pioneered this model. People can start using Zoom. They don't need permission from anybody in their IT department in all likelihood. They just start using it. They pay for it on their corporate card. Then it gets rolled up into some giant corporate account. The corporate account then expands. Hey, if you need Zoom, just email the IT department. They'll get you a couple of licenses. The end. All of this good news still is resulting in the company coming back down to earth. This year's 35% revenue growth is way less than the 3/4 of a year ago when they grew over 350% when the pandemic hit. How many Zoom calls were you doing? I wasn't doing any before the pandemic. And then 100% of our lives moved on to Zoom. So now it's like Restream is half my life. Zoom is half my life. Once in a while, I get a Microsoft Teams or a Google Hangouts, but not too often. And so revenue is growing, but the multiple they're trading at has come back down to earth. If you look at this chart, if you're on the YouTube channel, what you'll see is the price to sales in mid-2020 hit 120x. In other words, whatever their top line sales was, they were 120 times that in terms of the valuation of Zoom. Now it's at a much more reasonable 20x. In other words, if they made $1 billion this quarter and they're on a $4 or $5 billion run rate over the next year, well, they're growing faster than that, but $4 billion run rate, okay, 4 billion times 20, $80 billion market cap. So the market cap is coming back down to earth. So if you look at meme stocks, this is one of the problems with them, is that sometimes people who buy meme stocks are buying them based on momentum. They think it's going to spike, and they're just flipping the stock. When you have stock flippers who are day traders, the meme stocks then can face this compression. So when you see people trading at this high sales to the valuation, right, ratio, that is a huge problem. There was a group of them that were the Chinese stocks, which came back down to earth. You had the work from home stocks, Zoom, Peloton, etc., Slack, when they were. And Slack really didn't go up too much. That was interesting because I think the Microsoft Teams headwinds were very strong. And then, of course, you have meme stocks, AMC, Peloton to a lesser extent. Maybe also in that group was GameStop. And DoorDash got caught up in that, and Zoom, work from home, maybe even a little bit of meme in there. And when the actual people who hold stocks for a decade, like hedge funds or retirement funds, they want to hold on to 1 million shares of this company and hold it for a decade or two, like they hold their Apple or their Disney, and they never want to sell it. They don't want to take the tax hit. Okay, those folks are not going to buy the stock when it's trading at 100x the sales. They'll wait for a pullback and then they'll buy in. I think that's what we're going to see. That's probably why Peloton and some of these other things will do well. Of course, there was the OG meme stock, Nikola, which, remember when I was giving Nikola a hard time saying, hey, this company is not worth $40 billion. Everybody's like, oh, that's because your friend did another electric car company, whatever bullshit. And of course, it was a giant scam, and I was right. So victory lap here. With Rivian, I saw that thing go up to 130, 140 billion. I called that one out. I've been proven right already. I will be proven right that when that company comes down to 50, 40, 30, maybe my target $25 billion company, nobody is going to hold these things for a long time if they're overpriced. Why would you hold an overpriced stock? You would cash it in and then buy the underpriced stocks. So this is one of the problems we have in the stock market right now is people got too excited about China, too excited about work from home. The compression happens, reality sets in, and then you have these whipsaw moments. And what I think we'll see is a flight to revenue producing companies with great customers, which luckily Zoom is one of. Nobody's canceling their Zoom. It's just too good of a deal. It's too cheap, too affordable, and too good, right? It's a really great product. So I think this is going to be a huge company. I don't think they're going anywhere. I think they should be buying companies. They probably should have done secondary and bought companies at that high price. I think they did buy some. But this reminds me a little bit of the Silicon Valley famous talk, one we've had for many decades in the tech business, which is revenue equals death. And I'll leave you with this quick 50-second clip of Russ Hanneman talking about revenue versus pre-revenue companies. Couple of F-bombs will bleep in there. See you on the other side of 50 seconds.
Richard, one potential issue. Our hosting fees could become a challenge as we scale.
But we can offset a lot of that once we get a few customers and start a subscription revenue model.
What? Revenue? No revenue. I'll call you back. What? Why would you go after revenue?
Because to make money?
No. If you show revenue, people will ask how much, and it will never be enough. The company that was the 100Xer, the 1000Xer becomes the 2X dog. But if you have no revenue, you can say you're pre-revenue. You're a potential pure play. It's not about how much you earn. It's about what you're worth. And who's worth the most? Companies that lose money. Pinterest, Snapchat, no revenue. Amazon has lost money every quarter for the last 20 years, and that Bezos motherfucker is the king.
The king.
There's no revenue. No one wants to see revenue.
It's hilarious. And then they had, the part of the clip that's cut out is at the end, he goes, "You guys know what ROI is, right?" And they're like, return on investment. He's like, "No, radio on internet," which is the tip off that this character is partially based on Mark Cuban, who did broadcast.com famously and sold it to Yahoo at the peak. Before I start the ad read, just go to linkedin.com/checklist and you will get a $100 credit towards your first ad campaign on LinkedIn. Okay, let's get to the ad read here. Every startup founder and marketer has been in this situation. You know it well. You're planning to launch your new campaign. You know your audience. The team is happy. Everything's going according to plan. You love your creative. But you got that one thought in the back of your head, don't you? How can I be sure that my acquisition campaign will drive high-impact leads for my sales team? You need those high-quality leads. We all know that. And with LinkedIn ads, you don't need to guess. Because when you advertise on LinkedIn, your message reaches the people who are ready to engage you. They're in the business mindset. You know that. LinkedIn equals business. Business equals LinkedIn. The end. Over 30 million companies are active on LinkedIn today, and over 71% of professionals use LinkedIn to make business decisions. So, startup marketers, don't wait to start achieving your brand and lead gen goals. No, LinkedIn is offering our listeners exclusively a $100 ad credit to get started today. Get the Hundy and get your first LinkedIn campaign up and running at linkedin.com/checklist, linkedin.com/checklist. Terms and conditions apply because they're giving you a Hundy.